Okay, let's try to figure out just number one question, the average annual net cash inflow first. So first of all, if you want to know how much money you're collecting from this business, you need to know how many skiers are coming on a yearly basis and how much money you're getting from each skier every day. Right? So it tells you that the number of additional skiers per day after the expansion will be 117 people on a daily basis. And the average number of days per year that weather condition allows skiing will be 142. So just these two numbers here, you have 117 people and you have 142 days. So this will give you the annual passengers, or you can say the annual customers that will come to the business yearly basis. Then every single person, you'll be charging them $236. However, you also have variable cost occurred, so you minus this sales revenue by this dollar amount. So this will give you the annual cash flow that you're getting. Okay, this is just summarizing all this here. You start from the cash you're receiving from the customer, each and every person, $236, minus the variable cost that you're spending on these people, maintaining the entire skiing lodge, things like that, maintenance cost, operating cost. So overall, the net cash inflow per skier per day, you're collecting $160. The difference is between these two. And then that $160 you're getting from each and every person. Every day you expect there will be 117 people, customers coming. So every person you're collecting 160 times 117 people. Altogether that gives you a daily basis of cash flow, $18,720. That's per day. Then you time the days that weather condition allows people to ski, 142 days. So this is the first step. Before calculating rate of return, we need to know, and also before calculating the payback period, we need to know what is the annual cash inflow that we're getting, net cash inflow. Remember the differences between any revenue that we're receiving, 236, minus any cost of maintaining the place, maintaining the business, which is the $76 here. Okay, so this is similar to that $60,000 that we use for website portal. Remember, B2B portal? It's just that the problem directly give you that $60,000. Here we're calculating the net cash inflow on an annual basis. Okay, so this is the net cash inflow. What about operating income? We have to subtract depreciation, so how do we get depreciation from the problem then? We have residual value, $1 million, and that needs to be subtracted from the initial cost, which is the 13 million something. So 13 million something minus the residual value divided by lifetime. So the lifetime is 10 years. So because the first problem here, we already calculated the annual net cash inflow. To calculate the annual operating income, we get the annual depreciation too. Okay, so you will use that previous number, the every year's net cash that you're getting, minus any depreciation that you made. Depreciation for the asset given to you was the initial cost of the asset minus any leftover value divided by the asset's lifetime, 10 years. So every single year, the expansion that you made will downgrade this level of value. So $1,250,000. You have to subtract that from the annual cash inflow. This is given to you in the problem, the residual value. Okay, so if you go back to the problem, the residual value will give you the $1 million. Meaning, after 10 years, the asset's still worth $1 million. You can either sell it or try to rework on it to get that $1 million back. Okay, so again, the first one here, first problem gives you the net cash inflow that you're receiving. Second, if it asks you operating income, the differences between cash inflow and operating income is the depreciation part. So remember, operating income is an accounting tool. If we go back to accrual accounting, we always considered some of the expenses and revenues that, even though it's not actual cash inflow, cash receipt or cash payment, we still want to decrease it from the income that we're receiving. Okay, so we estimate that an asset's value decreases $1,250,000 every single year of its usage. So the operating income becomes this, $1,408,240. So from this information here, how do we get payback period? How do we know how long it takes for us to cover the initial cost? So how many years will cover the initial cost, which is the $13,500,000. So that is the initial cost that we're covering. Then we divide it by this number, not the operating income, the net cash inflow. Okay, so remember, payback period, we're using net cash inflow. Only rate of return, we use operating income. Okay, so payback period will be calculated like this. We'll give you 5.1 years to cover the whole thing. Okay, so after the expansion and after every single year's usage, it takes you 5 years to make this year's revenue that you're getting, the cash inflow, to cover the initial cost, $13 million. Okay, what about rate of return? Rate of return, we will be using the operating income, which is the one we got, and then divided by divided by 2, right? So the initial cost plus the residual value is $1 million divided by 2 will give you the rate of return. Okay, so you'll be using the first problem's the operating income you got from the second problem divided by the average level of the investment, which is the initial cost of the asset plus any residual values divided by 2. So again, what this ratio means is per dollar of average investment in the asset, how much operating income you're getting on an annual basis. So here we're getting 17 cents from every dollar of average investment we make to the asset. So this problem doesn't really tell us what is their desired rate of return. So assuming it's 15%, then this rate of return actually is pretty ideal because it covers the desired profit. If it's 20, then we probably need to think twice because it just doesn't cover the desired profit. Okay. So you'll be using this ratio not by just looking at itself how high and low it is, but comparing it against desired ratios or comparing it across different projects. Any questions so far in the first two analysis tools? So the first two that we mentioned here again is just usually used for managers level at a screening process to determine which projects that really takes too long to recover the initial cost and which ones the rate of return really is not ideal compared against their desired profit. Now for longer long-term assets investment projects that takes beyond 5 years, typically to 10 years, 20 years, we also need to consider the very important factor, time value of the money. Okay, so let's just cover briefly